Let's talk debt. Half a dozen countries like Sri Lanka, Pakistan, Chad, Ethiopia, Zambia have already defaulted on their debt due to Fed rate hikes, dollar strength, crude rally, and many dozens of emerging economies are paying 10 to 20% on their debt. But the biggest shock to the financial markets came last month or earlier this month when a developed market like the UK saw an evaporation of buyers and soaring yields. The problem is pension funds buy hedges or enter into derivative positions to protect the bonds in their portfolio or just earn more money. When the interest rates rise even above their hedge limits, they have to bring in collateral for which they sell more bonds. And this leads to a vicious cycle of selling of bonds and lower prices. That's why the Bank of England stepped in to buy bonds and protect the pension funds. Now, Eurozone debt is perhaps entering the same danger zone as the spread between the German bonds and the interest rate swap agreements undertaken by the pension funds have increased. European pension funds also find themselves facing margin calls on their derivative positions. But the interest rate hikes are not stopping. The Fed, the ECB and the Bank of England are still in rate hiking mode because inflation is at or close to double digits in all these countries. Today, I have with me two experts to discuss whether we could see some sharp dislocations in global markets and what does it mean for us. I have with me Alvin T, the head Asia Forex strategy of RBC Capital Markets, and Suyash Choudhary, head fixed income at IDFC Mutual Fund. Gentlemen, thank you very much indeed for joining me. Alvin, first to you. Looks like the UK problem is also being seen in Germany, in Europe, with funds, institutional investors having to sell bonds to provide margin calls. Do you think we are going to see an expansion of global debt problems, developed market problems?
Well, yes, as you mentioned, this is a manifestation, of the problems associated with the rising interest rate environment that we've been in, and I think what happened in the UK 2 weeks ago was certainly quite a surprise to many people in the market, and there's certainly a risk that it could spread to other parts of Europe. Certainly, Italian debt is now in focus. The Italian government will submit its budget to the European Commission this weekend, and we'll see if the European Commission authorizes this budget. But certainly, it is a rising risk as bond yields continue to rise further throughout the world.
Okay, these are sophisticated markets which emerging market equity investors don't understand much. It's an institutional market. So I just want you to interpret this for us. Do you think we could see more of a flight of capital from emerging markets simply because yields are rising there and there is a risk of?
Yes, cross-asset volatility is extremely elevated, not just in fixed income, but also, of course, in equities. I mean, it's been elevated this whole year. And on top of that, also elevated in FX, in the currency market. So definitely, further dislocation in financial markets across the world, further cross-asset volatility rises will exacerbate the outflows that we've been seeing from emerging markets, and definitely push the US dollar higher, and thereby emerging market currencies lower going forward. This is definitely, I think, a likely outcome in the next several months. The only question is, what is the magnitude of these outflows, the magnitude of these moves in emerging market risk assets and emerging market currencies. Okay.
Well, your thoughts on the same problem, Suyash. Can you explain to an emerging market investor how these rise in European debt, European yields and UK yields and even US yields impact us?
So, Lata, the essence of this problem is the way developed market central banks led by the US Federal Reserve are positioning their reaction functions. So they are basically, in essence, saying that we will keep hiking till we see inflation turn. Now, one understands Why they are positioning it this way? Because they are tightening via financial conditions in the financial markets. So they want credit spreads to widen, probably equity prices to normalize. They want real bond yields to rise, and all of that to have an impact on aggregate demand. Whenever they have started to provide nuance to their reaction function, markets have thought that they will pivot and they have eased financial conditions. Markets have eased financial conditions, which the central banks don't like. So we are almost in the midst of a tantrum on monetary policy normalization, because the pace at which rates are rising in a world that is now much more indebted than it was 10 years back is bound to cause some sort of a financial market accident. It could be at an emerging market country level. It could be on periphery spreads in the Eurozone that you just discussed. It could be at company level, refinancing level, etc. So at some juncture, probably this factor comes into play.
Okay.
In certain geographies, it has already coming into play. So you discussed the UK market, for example, where the Bank of England is actually having to expand balance sheet temporarily, which is counter to the inflation management framework that it's been operating with. But at some juncture, and probably these IMF, World Bank forums are helpful there, financial stability risk has to be put into the picture, and probably incremental financial market tightening is not desirable.
Okay.
Because there's absolutely no sense going one way and then U-turning for a bit of 10-15 days in order to address financial stability issues. And the sensitivity that world markets have to every incremental data point that comes out of the US has to subside. So for example, if you look at bond volatility indices, they are at multi-year highs and they're refusing to come off. I mean, probably, bond traders or financial market participants are psychologically just not geared to take this amount of day-to-day position management stress and, potentially the risk of something breaking in the very near future.
And you actually phrased it. Yeah, Suyash, you phrased it very well. Bond market is not prepared for this level of volatility. I think nobody at any point in time in our own lifetimes have been prepared for so much of a rate hikes in so short a time. It is not the 4% level or the 5% level, but the fact that it has come in 9 months. And perhaps what we have not realized is that a large number of financial institutions have leveraged on these zero interest rates or low interest rates, and they may create a problem before the interest rates start depressing demand. The central banks are raising rates to depress demand, but before that a financial accident may come. Alvin Tan, that's my question to you. Even before inflation falls or aggregate demand falls or US labor market unemployment starts increasing, can there be a financial accident in the form of some pension funds going belly up?
Yes, certainly. We could see that is a clear and present risk, which is why the Bank of England intervened the way it did 2 weeks ago. Regarding UK pensions and their bond holdings. I mean, that said, though, I mean, it's pretty clear from Governor Bailey's comments yesterday that Bank of England still considers the fight against inflation the primary concern at this point. So I mean, he reiterated that the bond buying will not persist beyond this Friday. I mean, it'll be interesting to see how the market continues to push the Bank of England in this regard. So definitely the risk of a financial accident has increased across the board, I would say, as yields, both nominal and real yields, continue to rise further, and also the US dollar continues to rise further. I mean, the rise in the dollar, I think, is almost as important as the rise in global yields. I mean, higher US dollar does tend to tighten monetary conditions in emerging markets.
Oh, yes, that's the other angle which I could not fit in. In the global financial crisis, it looked like the US was weak and several other countries had better capital buffers for their banks. Now it seems to be the other way around. US economy is extremely strong and therefore they can stomach rate hikes, but the rest of the world has a problem if the dollar strengthens so much. I take your point over there. But do you think the central bankers, okay, this question to you, Suyash, and then I'll come to Alvin. Do you think the central bankers are now, at the moment, all of them are in the fund IMF World Bank meet? Do you think some agreement may come, or do you think we are going to see more accidents? What I mean is, are we in the tail end of the debt crisis, or are we in the beginning?
So this is not easy to answer simply because I think developed market central banks have lost faith in their power to forecast. So, the lagged impact of monetary policy hike that will impact growth and inflation, let's say 1 year down the line, holds very little currency with them at the moment, which is why, the positioning of the reaction function that we need material change in data now. Now, obviously, it's very hard for the US Fed to say, because of global considerations, I will ease the fight on my inflation, because they are very worried that the inflation expectations, should they unanchor, it's very difficult to bring them back. So for the time being, I think there are no easy solutions to this, but you will probably continue to see country level interventions. Whether they become coordinated, probably that takes a little bit more time. It's already happening in a couple of markets where financial stability risks temporarily have overtaken the fight against inflation. But as more things continue to break around the world over the next 2 or 3 months, I would suspect at some juncture this becomes more coordinated, although probably we are still not there yet.
Okay, same question to you, Alvin. Are we in the midst, the start of the crisis, or are we at the tail end? Do you think the central bank commitment to lowering inflation and going ahead is giving them a blind spot on financial stability?
Well, I think that definitely the central banks, in the G10 central banks, focus remains firmly on containing inflation. Therefore, interest rates will continue to rise further. That said, though, we do not expect the Fed to persist in 75 basis point pace of hikes beyond the next one in November. So we do think that there will be an easing of the Fed's pace of hikes, although admittedly, that is very dependent on the inflation data.
One minute.
To see a slowdown in inflation momentum in the US.
Alvin, 1 minute.
So indeed, if that is the case, that the Fed's last 75 basis point hike is the next one, and after that it goes lower. I do think that we could perhaps evade a major financial crisis as the Fed continues to hike, and we think that the Fed's terminal Fed funds expectation, the median Fed dot for next year of approximately 4.6%. I think that's a fair one. And so if we do get there by middle of next year, then I think that we could evade a major financial crisis. But no doubt, the global economy is slowing down and will continue to slow down. But that is absolutely necessary to bring inflation under control.
Okay. Well, I guess I've just started the discussion and I'll have more of these. Alvin and Suyash, I'm out of time, but this is a spot we have to watch. The global developed market debt markets, which may get a financial accident before the central bankers are able to lower the inflation in those countries. So will central bankers pull back their rate hikes and concentrate on financial stability like the BOE has done? Will something skip their notice and there is a domino effect of a big institution failing? All these are possibilities on the table. We are going to live in difficult times, or as the Chinese say, interesting times. Wrap up on Bazaar on that note. Chartbusters bringing you more equity ideas.